Good afternoon. Afternoon all. Good afternoon. Making sure I'm coming through okay. Hope everyone's well on this Friday afternoon. It's been a lovely week for me, or for RTFX. Good trading week and actually a great trading month. I have to say, my best in certainly a few months, and took 2 months of quiet months to get to the big one, but that's what trading is. You be patient, and eventually you'll get a month like I'm having now, where you make quite a decent bit of return on your investment. So this is the second part of the series on my FTMO 200 grand funded account. I do it live, transparent. Everything is shown on screen, so you can see how a full-time trader does these challenges, or a kind of full-time trader trades, because it might be a bit different than what you're expecting. I know there's this image of what trading is. It's all action, and it's actually completely the opposite, really. There's a lot of waiting around and being patient, and letting your trades run and capturing more and more profit. So I wanted to do it live, transparent, because I feel like there's a lot of, probably, what's the best way to say it? The wrong image of trading on social media is portrayed. So a lot of social media fake traders, as I like to call them, promising the world and basically delivering nothing. I wanted to do this live to show you how an actual full-time trader trades the market and does it properly. So I'll bring up my results for the month. Now, my results for the month is not including this FTMO because I've just started my FTMO. This is my results that I've had for May 2021. You can see here it's been pretty great. And I'm going to go through my trade. I'm going to go through my market analysis. Then I'll do a little bit of a trade review and end the stream on that, so you can see why. One particular trade, I'll go through this Oz 200, why it was a winner, and why I really liked it. You can see here we've taken 9 trades. 1, 2, 3, 4, 5, 6, 7, 8, 9. Lost 1 and won 8. At the moment, sitting on 10% equity return. Now that for me is great. I always aim for about 3% per month, because I think that's a realistic goal. Normally for traders, you aim between 2 to 5%. Anyway, anything above that is, if you end up 6-7% return, that's excellent. I think if anybody tells you they're making plus 10% every month, to be very wary of that person. I saw on social media one day last week that this trader that had, I think, over 160,000 followers on Instagram, a kind of young guy. Not that that's an issue at all, but one of the questions or the Q&A he asked his followers was, or one of the questions he got was, what do you expect to make in return every month? And this person said anything over 15%. So this person was aiming over 15% per month. Now, to put that into perspective, right? To put it in perspective, and I just want to kind of hopefully educate some people who are watching that not everything you see online is true, as I'm sure you're aware. So if this person had a $100,000 account, which I presume if he's been trading for a few years, he probably does, whether it be a funded account or his own money, certainly if he's making 15% a month. Now, in 5 years' time, that 100,000 on minimum 15% plus return per month is $438 million. In 5 years, 15% per month, starting at 100,000, $438 million. And that's, you can do the math on that, that's no joke. So if you think about this, if you're looking at social media, trying to find something, somewhere, or a platform you can use or learn from, if this person had $438 million in his trading account, would he be selling a signal service for $60 a month? I don't think so. I wouldn't be. I'd be on a yacht somewhere, to be honest. I wouldn't be selling Telegram signal groups for $60 a month. So it just shows you the unfortunate image that I think trading is portrayed online. And I think a lot of people, myself included, have been scammed into you know, believing the hype and believing what certain individuals have said, that you can make this much off this investment, you can make 2,000, 2,500 every day off of 500. Unfortunately, it's not true. What you need as a trader is equity, right? And equity being money in your trading account, because you risk 0.5 to 2% probably per trade. And if you're returning 2 to 5%, you need equity. The more money or equity you have, i.e. if you have $100,000, $200,000, that 2 to 5% is obviously more than 2 to 5% on a $1,000 account. And how do you get that equity? Is doing these funded account challenges, FTMO, Top Step, whatever it is. And I always recommend to the members of RTFX that don't waste your time on a small account. Learn how to trade, get funded, and then use the income from your funding account to potentially put in your trading account. Use that income to get additional funded, and the opportunity for you, once you're a full-time trader, to have $1 million of funded equity is there. Because once you're profitable, you can trade, you know, whether it's $1,000 or $1 million, it doesn't matter. The returns are the same. It's just the numbers. There's just more zeros. So that's why I always tell people entering the market is learn how to trade first, and then get your funded challenges, get your funded equity up, so that the return every month justifies the reward that you're putting in every day on your trading journey. So at the moment, I'm sitting on 10%, which is great. And let's talk about the trade. The first trade I made on my FTMO was this Swiss yen. Now, Swiss yen was a 4-hour breakout. And last night, while I was at dinner, this big spike, because I'm trading from the UAE, so the time difference is slightly different. We are 3 hours ahead of London, and about 8 or 9 hours ahead of New York. And I took this trade on account of this cup with handle pattern, one of my favorite pre-context or pre-breakout patterns. I like 3 breakout patterns. First is the cup with handle. The second is the V reversal. And the third is the head and shoulders, which I'm not going to say what that looks like. But there's also more to all these patterns, because I like to actually see a cup with handle. Within a cup with handle, I like to see a V reversal plus accumulation or plus corrective prior to a break. And I like to see a head and shoulders where there's some sort of complex corrective, some sort of corrective, some sort of accumulation prior to that break. So Swiss yen, we had a nice breakout on this 4-hour chart at the start of the week, and we were then in this corrective phase. If you put lines on it, you could say it looks like a slight wedging structure above this previous resistance becoming new support. So that's an important note about breakouts, is you want previous resistance becoming new support, or old support becoming new resistance. That's the idea of breakout trading and breakout retest trading. So as a breakout retest trader, primarily I'm looking for breaks of this areas, retest of that area, the market saying we're fine with this break, old resistance becoming new support for the market to continue on its trend on an upward trajectory. And this is what we got. We can see that we pushed through, and price was basically accepting this area. Sellers were trying to push it down 3 times. Were not successful. And we ended up into that wedging structure, which once we broke out of, the market just completely boomed and moved upwards. Hitting TP, my entry was here. My stop was initially down here. I didn't get takeout on this. This is actually wrong, because technically when you do an FTMO funded, it's a demo account. Sometimes you get these spikes that are not actually there in the real market. So my TP1 was hit roughly around this area. And now, so I take 50% off at 1-to-1 risk reward ratio. So this is 1-to-1. And what I mean by that is, if this is my entry and this is my stop loss, let's say I put $1,000 on this trade, for example. I make 2 trades of $500. So if I'm placing 10 lots on a trade, I will do 2 trades of 5 lots. Right, and my first TP on this let's say this $500 trade is here, where I make $500 of profit, i.e. 1-to-1 risk reward ratio on this particular trade. So in terms of the full trade, if we talk about R's, so risk rewards, which I like to talk about. So 1R is if I put $1,000 on a trade and I make $1,000 in profit, that is 1R. Okay, if I make 2R on a $1,000 trade, I'm in $2,000 in profit. That's that's how risk reward works. So once I banked 500, it technically means on that trade I have banked 0.5R. However, I keep the second trade running, or the second 500 running, and simply move my stop to the swings in the hopes that that trend continues and I can keep capturing more profit by moving my stop under the correctives as the trending market continues. So I found that doing that helps me capture those big profits the times that those trending markets do come. Now, they don't come often. You know, you don't get a lot of them. You get some of them. As you see by my results this month, there's not been a lot of over 1.0R. These two are in progress at the moment, so we can't categorically say what they're going to finish at, but I've had a lot of trades where I've taken money that 0.5R off, and we didn't really get that much more of them. However, because I've won so many, or because my win rate has been good this month, you know, I've managed to get a great return. So it's just building up those returns, building up that money, keep banking cash and banking cash. Little by little, you end up with a good return. It doesn't always happen. 10% is a good month, but it just shows you the power of taking those little gains time and time again. So the saying, go for the home run, but take a single, is very prevalent. So we bank the money. The market's giving you the money. It's saying, here's your profit. Just take some off. Take some money. Pay yourself when the market makes it available. Because how many times have people maybe be in a trade here, possibly up in profit, let's say 1 or 1.5R, not taking any money on because they think it's going to continue, and it ends up coming back, hitting their stop, and you end up losing on that trade. So a good thing about that 1-to-1R is if this does come back, now my stop has actually moved up, so I've reduced my risk. If this does come back and hits my stop, let's say I didn't move it, it would end up being a break-even trade. So you don't win anything, you don't lose anything, you move on to the next. So psychologically, that helps for me. Just taking that money, and I really enjoy when I see that TP1 being hit, because now it's risk-free. You know, it's risk-free. I'm not going to lose a full R on it. And if this does decide to go for another leg, let's say we have a corrective here, possibly in that 38 to 60 Fibonacci box in terms of retracement level, 38 to 61.8, let's say, because I consider this 61.8 being the line in the sand. So if it comes down here, it's probably not going to be part of trend continuation, certainly in the intraday kind of charts, or for the short term. So we could see a retracement here to that, you know, let's call it the 40-60 box to make it, you know, a little bit nicer. And if we continue on, this stop will be moved up here, we capture more profit, and hopefully we continue to do that. So letting those winners run. So with the Swiss yen, it was a really nice trade. Really nice trade. This is looking back in hindsight, this is great to see. You know, it's just that consolidation, that coiling effect. You know, and it looked to me like it was ready to snap up, and that's exactly what it did. Completely snapped up, hit our TP1, and now let's wait. So at the moment, on that first trade, we are sitting on balance of 201,987, which is the 0.4R bank, because I placed 2% per trade. Excuse me. So that's $4,000 on this 200 grand account. I'm more selective, so I'm allowed to increase my risk. So we banked basically 2 grand, which is half that $2,000, and we're letting our second trade run risk-free, which at the moment, remember, this could come back down and hit our stop, and you know, if it does, that's okay, that's trading. But at the moment, sitting on about 2,830, so almost no, it's another $1,000 to get double, 2R out of that particular trade. But at the moment, that's running quite well, and we're just waiting to see whether we get that swing and move our stop to keep capturing that profit. So that was a really nice trade. that really motored on, because I remember checking it when I was in dinner and thinking, wow, what's happened here? Because I don't check the charts all day. I don't spend 15 minutes. I just place my trades and go away, do things I like to do, come back when I need to check them. So as I said, trading's not like the movies where it's all action. It's actually quite the opposite. USD was another one that I didn't take. I'm kind of going through this so you can understand what I mean by letting winners run. So I took this trade on a breakout on my actual account. This head and shoulders. And the main thing, what I do like to see within breakouts, so I take the breakouts on the 4-hour and daily chart, and I trade the breakout retest on the 30-minute, 1-hour, 4-hour, and daily. I don't take the breakouts on the smaller time frames because I found that you're more susceptible to fakeouts. Fakeouts happen the majority of the time. Fakeouts happen probably 70% of the time. And they happen a lot on those smaller time frames. And doing my backtesting, doing my research, I found that trading on the breakouts on the higher time frames has a much better win rate than on the lower time frames. And I psychologically as a trader, I like to win more trades. So I don't like to wait for that massive trade to come because I don't like losing 4 or 5 trades before that big winner. Psychologically, I can't handle it. And that's just from a personal point of view. Maybe you can, but personally, I can't. So I like winning more trades. Even though I don't make as much money from my trades, I like winning more than losing some than having one massive trade. I just, your emotions kind of go like this to this to this. And for me, that's too much of a swing for me to handle. Anyway, so this USD, it was a nice head and shoulders pattern here. I wouldn't have taken the breakout if this continued to break on through, but this 4, 8, 12, 16 hours of accumulation, letting that simple 20 period moving average catch up, allowed me then to take that breakout of this level. My stop was above the previous swing, so my stop's always above the previous swing, which allows the trade room to breathe. Previously I put my stops too tight, and before I would have been stopped out of that trade because my stop was too tight, as we see a lot of, you get a lot of volatility around these breakout levels because, there's a lot of volume coming into them because you've got buyers, sellers, etc. at, certain big price levels. So you're bound to get some volatility, which is why I like to put my stops a little bit higher, and which means I'm okay that this happens. So we got that corrective after the break, and then we ended up motoring on down. So my TP1 was hit somewhere around here, 1-to-1 banked, and now waiting for another swing, which looks to be happening at this point in time. So, the dollar's been weak. The dollar's been weak for a long time. I think any strength in the dollar will be sold into, because in terms of trend continuation, people might be selling into these pullbacks into the dollar, which is what we might be seeing at the moment, because if we just put a simple channel in it, that's what it looks like. And, people don't believe in these chart patterns, basic channel wedges, etc. There was a study out previously that if you traded every single chart pattern every time it happened, it's not profitable. And I actually agree with that, because for instance, if you had a massive push and you had that's not a good example, a massive push and a tiny chart pattern like this, I'm not going to play that to the upside, because it's not digested this move enough. So it's about the context of where these patterns come from. The context of where you see the pattern is very important. So yes, I agree, if you use chart patterns all the time, they're not going to be profitable. I agree with that. It's the context of where they come. So breakout, corrective pattern or channel, if you want to call it, back to that simple 20 period, rejection of that simple 20 period, and continuation to the downside. So that was a nice trade that I took on my previous account, and not this one. Now, the only thing I'm looking at today, it is a Friday. Sometimes you don't get a lot of setups on a Friday, similar to a Monday, is Euro Swiss. So I'll go through the one that I'm looking at the moment, which may not set up today, but it's still looking okay. And it looks quite similar, right, to USD. Head and shoulders again. You can call this a V reversal, followed by another V reversal, followed by another V reversal, essentially saying that, pressure is rising into this support area. So we've tested it 1, 2, 3, 4, 5 times. Now, this is where each individual is different, because people might think, well, it's tested it 5 times and it's holding, so I'm going to buy this level for it to go up. The other side of the coin is, well, it's tested this level 5 times. Eventually, that support is going to break, and that's the ethos that I have. You know, if this does end up giving us another possible reload down, I couldn't take the break there because, again, I like to see the 20 period close by to avoid that. Try and avoid those fake breakouts. I like to see the 20 period, simple 20 period close by, and possibly accumulation here prior to a break of the level. So we've got a 20 period kind of pushing down price, you know, putting downward pressure on price, and hopefully that accumulation, what I consider possible load up in positions. So institutions possibly loading up in their positions before taking this currency pair, equity, whatever it is, to the downside. So Euro Swiss I do like. It's not ready. Again, this is where the patience come in. I can't just, you know, take a sell order here because I don't think it's going to breach these highs, and you know, eventually I think it's going to go lower. I have to wait for the actual setup, and that's where the patience of trading comes in. You know, I'm not the smartest person in the world. I'm not, you know, but before I'd try and take too many trades. Now I'm much more selective, because once you get into that role of winning trades, you don't want to lose money. You know, you've had that experience before when you're learning on a trade of losing a lot of money, and it's not a nice feeling. Even though being in a trade is exciting, making consistent return is far better than being in trades every day and losing most of them and losing money. So I like being selective now, you know, because firstly, it makes me more money, and secondly, it's, you know, makes me a bit more relaxed, because I know, you know, as well with using bigger stops, I know if I place a trade, it's probably going to take a few days, so it just allows me to relax. And eventually, when those trades start to come in and you start to see consistent profits, it's, you know, far better than what I went through previously. Because let me tell you, I had a very tough journey learning how to trade, a lot of stress. I think I broke my door, I broke my desk, smashing my hand on the desk. So it is, don't underestimate how stressful trading can be, and making little changes, being patient, being a bit more patient, being a bit more selective, I think can massively help an individual trader. So essentially what I'm looking for, go back to Euro Swiss, is falling pressure into that area, you know, something similar to this. We let that 20 period come down, touching, you know, knocking on the door time and time again before eventually probably breaking through. Well, hopefully breaking through. Now, if we get this price action, as I kind of said here, this lowering pressure into the level, then I will put my sell stop in. I'm not as worried about this volatility spike. I'm taking the level that I find is the most respected. So this area or zone, I think, is more respected than this volatility wick here. You may, because I consider, if this does break through, that these buy orders have been filled, and therefore this won't hold as much support as this kind of level. So if we break through, I'm happy to take that break and just consider these orders being filled, and those buyers basically buying from this, you know, supply zone or demand zone, sorry, to probably start exiting their positions if this market does move down, in which case sometimes you can get quite a sharp move to the downside. If we add in our confluence, so higher time frame confluence with that, we can see from this rise, Euro Swiss is what looks to be, and I was looking to trade this to long side, look to be at this point in time in a corrective. That's slightly changed now from a break here. And remember I said the 61.8 is the line in the sand. Let me zoom in, that might be easier. Sorry, there we go. So this 61.8 is the line in the sand for me in terms of trend continuation. And on the daily, again, you can see that head and shoulders on the daily, 20 period coming down. We're seeing the breakout, you know, I'm not going to take the trade. The breakout will be underneath that 60.1.8, which again indicates to me there's a possible trend change there from this larger move to the upside. This larger move to the upside to now changing trend to potentially coming back down. So that's Euro Swiss, and it's really the only main one I've been looking at. Okay, I'm going to do another trade review as a bit of a educational thing here. A trade review that I really liked, and then we'll leave it there for the Friday afternoon. And it was here. Head and shoulders, as I said, a head and shoulders pattern that I like to see. Head and shoulders. Now let's take the context first. I'm a bottom-up trader, which means I look for the setup first, and then I look for a higher time frame confluence. As you can see, and you can see my charts here are laid out. For me, makes it easier to see that higher time frame confluence just through a snapshot of me looking at it. Because I think if some traders have charts like this where they flick through, it's harder for me to really get a better idea of where that market is. You know, because you might take the daily and then not remember what the 30-minute or 15-minute looks like. Whereas if you have all 4 charts here set up like you want, it's very easy just to have a quick multi-time frame analysis view of what's going on in that particular currency pair. So Euro or Oz 200. Now the setup came here. So this is obviously the setup. Now it came from this impulse to the downside. Now the head and shoulders is known as a trend change pattern. So it indicates that potentially downward movement is going to change to upward, or upward movement is going to change to downward, looking something similar to this. So if you have uptrend, looking at a head and shoulders, potentially indicating downward movement. If you have downtrend, we've got an inverse head and shoulders indicating upward movement. Again, that is the theoretical definition of a head and shoulders pattern. So, even after, again, if this had broken through this level here, let me zoom in, there we go. If this impulse had broken through this level, I wouldn't have liked it as much. Now that we had, remember, a slight corrective accumulation back here, and look how it touched that 20. Again, simple 20 moving average, same with this bar here, touched that 20 and rejected it, and then pushed through, had a strong push through. So, even though this is a great head and shoulders, adding this into it gave me added confidence that a break here would be, or break and retest, because remember I can't take the big breakouts on a 30-minute, a break and retest would be a good trade. Big rejection here on this hammer, which gave me my stop of my previous swing, push through, and we got a really nice steady state retest back to this area, i.e. previous resistance becoming new support. Now, if we dive into this retest, what I like about it, firstly, is we've got no candles here that really stick out to me. So there's no massive candles like this. There's no big bearish engulfers like this. No big impulses like this. It's kind of small-bodied candles coming back to this area quite nicely. You could call that an ABC if you really wanted to. And that's what I like to see. Also, look how we've got lowering volume on that retest as well, which is another thing I like to see. So at the moment, everything on this trade is going for me. All I need now is a catalyst. So forget we see all this. And here we got, at this level, complete rejection. See a wick even on that zone I've identified there. And a lovely bullish engulfer, which if you put a descending trend line on this, breaks through that descending trend line as well. Now, I don't use trend lines really in my trading. Sometimes I use them basically for confluence. But if you did decide to put a trend line, if you do like that, it also broken through that area as well. Now, not only we got engulfer, we got volume coming into it. Now, I consider volume coming from institutions. Retail traders like me, like you, don't really move the market. So we want to be piggybacking onto these institutions, the big boys and girls that move these markets through millions and millions of dollars. And I consider higher volume for those institutions to be participating in that particular candle. So we took that trade, entry in here, stop loss is the previous swing, which is this area here. Again, same tactic. And this trade actually came on NFP. So non-farm payrolls comes out the first Friday of every month, and it can cause volatility in the market. So we pushed on, and this is where NFP came, which may have made, you know, if we after the numbers came out, which actually were poor numbers, you might have been worried at this point in time. You know, the market was moving quite sharply down, and you're probably worried that this is going to come out and stop you out quite quickly. Which is why I always kind of have the ethos, if there's big news events coming out and you do have a position on, I don't recommend putting a position. So if NFP or interest rate decisions are coming out for the US dollar, I don't really recommend trading the US dollar until afterwards. Same if there's a Bank of England interest rate decision now, I don't really recommend trading the pound until after that news comes out, certainly 15 minutes before and 15 minutes later. Let that market digest the moves, because what you can see is short-term volatility where people are get stopped out, and then it usually goes in the direction of that trend, the higher time frame trend. So I just, you know, a good thing to do is just get away from the charts for an hour or two, come back, in which case, you know, we rejected this resistance area, nice morning star, good volume on that engulfer, and we pushed on. This was Friday evening, because NFP is on Friday. Gap down on Monday open, and then bang, went up, and TP1 was hit. Entry was here, stop loss was here, TP1 was hit roughly about here. Big impulse, and because I was worried about that big impulse, I moved my stop to this anchor. I didn't consider it a swing, but I consider it an anchor, meaning if we have two on a anchor to the uptrend, we need 2 bars, either side being higher than the low of this one. Again, for a downtrend, we want this bar to be higher than 2 here, 1, 2, and we got that within this hammer candle. 1, 2, 1, 2 being higher. So I moved my stop there and ended up taking out here. Now the importance, as I said at the start, of taking money when the market gives you available is, look at that. So look what happened after that impulse. So if you're trying to get too much out of it, you would have been stopped out and lost money on that trade. Whereas taking money off the table, paying yourself when it makes it available, that ended up being a winning trade. So there's a kind of example of making sure you do take money off the table, which I believe that, you know, even if it's 20%, 30%, etc., you can put 3 or 4 trades on, whatever you want to do with your trade management, to make sure you're paying yourself. And again, psychology, we know psychology is 70%, strategy is 30%. Paying yourself that little bit of money, so if it does come down and hit your stop loss, it's not as bad as a loss, because going from, you know, this side, you're probably ecstatic that you're making all this money, and then your emotions go right down if you don't take any off the table, and you end up getting stopped out. So just as an added thing here with the confluence of this pattern, in terms of that impulse down ahead and shoulders, within this break of this level, this resistance level, right, you can see it was quite a significant bar here, which are susceptible to fake outs, as we've seen on this large bar here. Look what happened here, which is different to, look, we've got a V reversal here, and we've got this period of consolidation or accumulation prior to the break of the level. And look what happened when that happened. After we get that accumulation, this break has been sustained and not just immediately fallen through. So it's very important getting that kind of load up of positions before taking a breakout level, because you don't want to be caught in a fake out, because no, they're not very nice. Usually if you get caught in a fake out, you're taken out pretty quickly, and it doesn't feel very good, right? So this is why I liked, again, the concept of the trade, because it looked to me like this could potentially be faking out. The AUS 200 could be faking out, and that's exactly what it did on the 30-minute. There's your fake, come back down, head and shoulders, potential trend change, because the AUS 200 was on an uptrend, right? We're on an uptrend. At the point in time, it was here on the daily. So if we can't see any of this, let's take all this away. I'll do it like this, that maybe is better to see. We take this away, that looks really nice, does it? So I fancied it. My bias was to the upside, and I was just looking for an entry. That 30-minute gave me an entry, and everything about it was perfect. Head and shoulders, you know, reload back to the 20, good push through, nice retest, smaller candles, nothing's coming out, you know, nothing's jumping out on the chart. Big engulfer on volume coming in, you know, entry in there, buy stop there, take some money off the table, the impulse, start to move your profits or move your stop loss and get out of that trade for a decent amount of money. and move on to the next one. That was Oz 200, and hopefully that's good. Let's go back to Swiss yen, see if it's doing anything before I leave, and enjoy my weekend after having a nice month. I don't think I'll get a trade today. I might get a trade on Monday for that Euro Swiss, so have a look at that if you are looking. But it's certainly a day for me. No new setups, and I'll go and enjoy my weekend after having a great week. So if you've got any questions, let me know or write in the comments, and I'll happily get back to you. But thanks for joining, everyone. I really appreciate that. And have a good weekend, and make sure that you trade safe. It's the most important thing. Thanks, everyone.